Welcome to the briefing for Monday the 28th of November. Just taking a quick look then of the weekend's news flow in the charts this morning and what to expect from today and this week. As you can see already by my DAX and S&P in the middle of my charts, already under pressure right from the off, really from the cash open, a bit of extension of the pressure to the downside. As you can see though from the other asset classes, we've got bunds down in the bottom right, Eurodollar and cable top left. Not so much movement in the other assets. It's a little bit being more isolated to equities specifically. We're going to talk about the reasoning behind some of the moves potentially this morning, but just taking a look at the S&P, this really being one of the first real reasons was that obviously we had a Thanksgiving impacted week stateside, which obviously impacts the volume globally. Second half of last week. And you can see in electronic trade, at least, we closed early on Friday at 6 o'clock our time, but you can see prices just grinding up into the close. Thanksgiving cheer making the S&P close up. Well, at the highs, we were printing at 22.11 on really not a lot of news flow. And so the gap lower this morning, we opened back to around 08, drifted around pivot through the overnight session before seeing some selling pressure really as the early traders came in the UK and Europe. The DAX then consequently following suit has seen a small gap lower, and then really it's when the cash markets opens we've come under pressure. We're going to discuss a few reasons why probably there's more downside bias than upside from these levels. I think for one, certainly these record high levels we printed and drifted to at the end of last week. I think it's got a bit to do with it. Profit taking is what I'm talking about. Actually, if we just flip charts and take a quick look at the dollar this morning, this is the dollar on daily candles, so you can see where my mouse is now. That was Trump and the very aggressive rally that we've had really for 2 weeks straight in the dollar. If you look at the dollar index this morning though, we're down 0.6%, and we've again gap lower a little bit, and we've come and reversed some of the initial highest levels that we've seen only around a couple of days ago, but it's helping keep both major pairs elevated in the terms of Eurodollar and cable, both sitting up respectively around their R1s at the moment in those pairs. But looking at the dollar, there's obviously a lot of people looking at the pullback. Bloomberg kind of running their summary type article that they do every morning. Dollar caution returns, technical indicators showing the greenback may be overbought. They're looking at this decade high that we're printing in the Bloomberg dollar spot index. Again, it was near 14-year highs we got to in the dollar index by other measures last week. And they're looking at matching it over with the RSI, which at these levels hasn't been this overbought by that measure since, well, really early part of 2015. So just given the speed and size of the move to the upside the dollar seen, I think it's more plausible now to have a little bit of a pullback, especially now we've got over the hump of Thanksgiving, where the liquidity obviously was very light. A quick look then on some of the other reasons why I think particularly the European indices under a bit of pressure. And one thing has been is the Italian banking sector opened down around 3% this morning, sitting around 8-week lows. I think Monte Paschi shares lasted the grand total of a couple of seconds before they were halted in Milan trade, down 7.5%. You could say that's business as usual when it comes to the Italian banks, but certainly sentiment is going to get ever more nervous, and Italy's one in terms of the Italian-German 10-year government bond yield spreads you want to be watching, as well as sensitivity in Italian bank stocks, because of course it's this weekend on Sunday we get the Italian referendum, and so by this exact time next week we should know by then what the situation is with Italy in regards to that referendum, and then the fate of course of Renzi, and then where we go from there forward. So a couple of articles obviously talking about this issue. The FT leading with fears mount of multiple bank failures if Renzi loses referendum. The gist of the story that they're talking about here is that essentially because Matteo Renzi has pinned his political future on this constitutional referendum, if it goes against him and he steps down, it's going to take a period of time for a technocratic government to be formed, and then that increases political uncertainty in a banking sector which is highly indebted and already under pressure. 8 of the banks are in various different stages of distress, they're called. Monte Paschi obviously being one of the biggest ones that are most familiar in the press. But of course, Italian banks have 360 billion euros of problem loans versus 225 billion of equity on their books, after successive regulators and governments failed to tackle a bloated financial system where profitability was weakened by a stagnant economy and exacerbated by fraudulent lending at several institutions. So, it was a couple of months ago when the market really got nervous about that bad debt situation, size of it, that prompted government 5 billion euro capital or recapitalisation in the banking sector, and they're looking to consolidate a lot of these weakened smaller banks. But political uncertainty will only mean that this again will become a key issue focus for the market, and you can see that already playing out this morning, because the timeline now is we're in the week of the referendum. So I would certainly be expecting probably more downside bias to those Italian bank stocks, and that could weigh on overall net sentiment as we get towards the latter part of the week. Looking elsewhere, the banking sector overall this morning has been weaker. Britain's biggest banks struggle with tougher stress tests yet. Later on this week, we get basically the Bank of England's own version of stress tests, where 7 major British lenders tested will probably beat the lowest measures of strength required to pass the annual health check. However, there are a couple of research analysts saying that RBS and Barclays risk a soft fail of tougher thresholds. Again, a stress test essentially is setting out various different scenarios of an adverse economy and the shock that could have on a bank's balance sheet and how they would be able to react in those scenarios. And what they're saying is that although they might pass the more easier stress test, when it gets more aggressive, RBS and Barclays in particular could be questionable. HSBC and Standard Chartered's results may be rattled by a Chinese recession scenario. Again, HSBC, Standard Chartered in particular, very large exposure to the Far East continent, and any hard landing or slowdown in that particular geographic region does have a much more direct implication on those 2 specific banks as well. So very much a banking theme, I guess, that might have just drawn a bit of attention from this morning. And then moving on, to continue with the doom and gloom for this morning, you've got the results in, or initial results, for how Black Friday has fared in the US. Now, as you know, this is now a real big kind of, for the retailers, one of the biggest days certainly in their calendar, and so a lot of their fate of their financial performance is pinned on the back of a successful Black Friday. And one of the numbers which I saw, which is the main industry body in the US, which is the National Retail Federation, they said that early holiday promotions and a belief that deals will always be available took a toll on consumer spending over Thanksgiving weekend, where shoppers spent on average 3.5% less than a year ago. Now, if you think about it, Thanksgiving, in terms of Black Friday and spending associated around that holiday, has increased, especially online spending, as people have become more comfortable with the new social behaviour of making transactions via a mobile application. And then retailers have really caught hold of this. The better technology's got, the more comfortable people have got with buying things via that format. They've really given them a boost over recent years, but certainly a bit of a surprise to see that overall shopping down 3.5% from a year ago. So maybe as well that's just dampening a little bit of sentiment, and certainly when the US come in, that would be something I'd be watching on a sector breakdown. But again, from a real asset class point of view, one of the things is when I look at the charts like this morning, I see equities under quite aggressive selling pressure, but fixed income, okay, it's up Bunds 35 ticks, T-notes 13, but most of that happened at the gap on the open. Likewise with the currencies, they really rallied overnight. They've really done nothing so far when these equities have really sold off. I mean, that to me then means that there's not one real sea change macro factor or one headline that's driving the markets, because it's specifically equities that are moving. And I think at this point they've just been a little bit susceptible to a bit of profit taking, those overextended moves that we've had on the close in Wall Street on Friday, prompting a bit of a gap lower, a sell-off this morning, some concerns over Italian banks, UK banks, disappointing Black Friday, and then the dollar, as I said, maybe slightly overbought from the strong run-up post-Trump, and so it's down 0.6% this morning. Throw in the mix as well, you've got WTI crude. Obviously that's trading a little lower this morning. Probably a couple of headlines to be aware of from the oil front. Saudi Arabia late last week pulled out of planned producers meeting for today between OPEC and non-OPEC countries, calling the meeting not beneficial before holding meetings with OPEC and deciding whether to cut or continue with current levels of production. So if you remember, we did see a decent sell-off actually on Friday before we reopened electronic trade last night. That was pretty much the low point that we hit, just above $45. I think if we put the oil chart a bit longer dated, if I just clean this up slightly, you can really see the fluctuation of oil price over the last really 2 months. It was when oil got sub $40, which was really in the summer. That was when we started to see OPEC get quite vocal about verbal intervention into the market, started talking about coordination, the likes of Saudi and Iran. The Algiers deal came into play obviously back in late September, early October. We continued to rally up, got up to close to that level that was printed earlier on in the year in June, before hitting some resistance around 51.60 type mark, or just shy of 52, and then we've pulled back. So again, this is kind of that buy the rumor, sell the fact type price action that we're seeing play out in oil, on the premise that as we get closer now to the kind of decision, which is this Wednesday from the official OPEC meeting, whether or not they can actually push something through is still, I think people are more than cautious. Looking at the latest headlines, there's a couple of pieces that have come out over the weekend. OPEC is embarking on a last-ditch diplomatic push to reach a production cut, with ministers flying to Russia for talks. Saudi Arabia for the first time suggesting the oil club doesn't necessarily need to curb output. So again, even the Saudis now are starting to take their foot off the gas a little bit on this push for a cut. And consequently, looking at crude this morning, then we've continued really, although we've bounced from the initial low overnight in Asia, as soon as Europe's come in, we've hit the sell button again. We're down around 50 cents. All of this, though, looking into the other assets, is led to a bit of a flight to quality in gold. And gold was obviously a very interesting asset in the last week, because we obviously broke that very psychological 1200 level. You can see this now on my chart. That was a really important level psychologically and technically. That broke. We saw quite an aggressive extension to the downside and actually hit a low down at 1170. But as we've spoken about a number of times, is this now good value in terms of, given the risks forthcoming? Obviously Italy is now this week at the weekend. The French situation, we'll quickly touch upon that shortly. The Fed, how many hikes are they going to do? Trump implementation risks, so on and so forth. Certainly, we're already really back to 1200, 1195, up 16, 17 bucks this morning, amid this kind of profit taking of some of the moves that were seen in the second half of last week. So I still foresee, I think, a move back above 1200 this week. Certainly with the risk associated with Italy, I would imagine we will see increased volatility in that particular stock index, the FTSE MIB, and the associated Italian bank stocks, and that will only lead to wider peripheral bond yield spreads and force this price back above 1200. at least in the forthcoming sessions, I think. A quick look then on France before we look at the calendar for today and this week, because obviously there was a development there as well at the weekend. Fillon wins centre-right primary for the French presidential election, beating Alain Juppé. So this now moves on to, well, really it's May when this really kicks off. So it's in summary, the Republican candidate for next May's presidential election in France will likely face a socialist candidate and also his main rival, of course, the far-right's Marine Le Pen of the National Front Party. In fact, Bloomberg reporting 2 polls this morning, both of which show Fillon is beating Le Pen in both rounds of the presidential election by a fairly comprehensive margin too. Now, I did see... let me just go on to my Twitter feed, because I did tweet something I saw last night, which was quite, I thought. So I saw a tweet saying that Fillon moves now, after he's won the kind of runoff for the Republican candidacy, Fillon moves to 69% chance on Betfair of becoming the next president in France, after winning the Republican primary runoff. Now, the point I was making is that at the bookies, Remain in Brexit was 90% assured, and Clinton was 84% on the day of those respective votes. So Fillon at 69%, well, it's a done deal then, he's going to lose. As far as if you were to go off history, the polls as well, it's becoming very difficult to really put too much faith in this, having been burnt twice. I think people are a little bit nervous and reticent to put too much faith in the polling system, but as I said, if you're looking at the polls that are out this morning, Fillon defeats Le Pen by 71% and 67%. Pretty comprehensive, but as I say, it feels like we've been here before, and if anything, these numbers are even lower than what we've seen before. But maybe this is just a bit more of a reality check now. The market's been a bit more serious about the kind of more far right-leaning parties and their ability to gain some traction. So looking at the calendar though for today, just to wrap things off, there's really not a great deal coming out from an economic data perspective. These economic sentiment numbers coming out of Europe at 10 o'clock, I know it looks quite there's a real batch of data, but none of this is really market moving. These are just regular, I would say, third tier, I would classify them, monthly figures. From the US, likewise, also nothing of interest. A couple of speakers of note, most notable being ECB's Draghi, but to put in context, speaking in a quarterly hearing before the Committee of Economic and Monetary Affairs in Brussels, so probably not going to be mentioning anything too great that we've not heard before, but nonetheless, I would remain tuned in at 2 and 4 o'clock respectively, just in case Draghi does make any interesting comments. Looking at the week as a whole though, you can see Monday really is the most quietest day in terms of the scheduling of events. Tuesday you get the preliminary CPI numbers announced in Germany and Spain, mortgage approvals in the UK, a couple of data points in the US, the preliminary GDP, consumer confidence, and Fed speakers are quite prevalent throughout the week. You've got Dudley Fisher Tuesday, Kaplan Powell Mester Wednesday, and then we continue through the week. Wednesday, those probably Wednesday and Thursday are the most interesting in terms of schedule events. From a US perspective, on Wednesday, obviously you get ADP employment change. This is the run-up into non-farm payrolls, which we'll see on Friday. So you get the various different jobs data we'll need to look out for. This includes then the Chicago PMI number, as well as the OPEC meeting. This is all happening on Wednesday. We'll talk about the OPEC meeting closer towards the time, but you're more than likely to know the outcome of the OPEC meeting way before the OPEC meeting actually takes place. Those of you who've been in the market long enough will know that OPEC members tend to telegraph their decision making before officially unveiling a decision at their scheduled press conference, which is typically in the afternoon of the actual OPEC meeting day. Doorstep comments will be key for that event. Thursday then is also a very important day because you've got Chinese manufacturing PMI, both the government and Caixin readings, and then through the morning you get the various European manufacturing PMIs, but in context these are the final readings. You get ISM manufacturing, construction spending. This all then culminates into the non-farm payrolls reading, which we'll get on Friday afternoon. Okay guys, so a bit of risk off this morning for those reasons mentioned in Europe, a bit of Italian risk maybe on the table. A couple of suggestions that a couple of the UK banks might struggle as well in their respective bank stress tests, which I think is on Wednesday. And then you're looking elsewhere, though, it's very much equity related thus far, but I think a bit more of a case of as well profit taking, particularly on those dollar longs that have been such a strong theme since Trump got into the White House. So that's your morning briefing. Enjoy today, and I'll catch you in the chat room. Have a good week.